Poggioli. I am one of the two managing partners of Access Capital Partners, a company we created some 27 years ago, focusing exclusively on the European market with two main business lines, one being smaller European buyouts in private equity, and the other one being equity investments in European infrastructure. The company is operating out of six offices across Europe, so we have a pretty strong footprint on the European market. We're more than 100 people covering those two business lines, and we have a client base which is mostly European and trying to expand that beyond Europe. We're a specialist of the small cap space. And in that, we've been investing exclusively in that space for the last 27 years. So we have a very strong ownership of that market, which is a complex market. You're looking at more than 600 managers across Europe that are investing in companies of enterprise value of less than 100 million euros, which is really the core of our investment target. So a complex market, one where you have to have the team and the knowledge in order to select adequately the right investments. Because inherently, this is a very attractive part of the European buyout market because of lower entry pricing, lower use of leverage, more opportunities for growth, and the ability to go across borders in the European context in order to consolidate more fragmented sectors of the economy. So definitely in that space, we are a market leader, a primary investor in funds, a secondary buyer of fund positions, as well as a co-investor in deals. When we are an investor in funds, we're typically the largest investor. That's why we command that market leadership, and where obviously we attract a lot of attention from GPs. So from that perspective, we have a lot of synergies between our primary, our secondary, and our co-investment activities. So I would say that that's a very defining picture of what we do in buyouts. In infrastructure, we're slightly different. Again, we focus exclusively on the European market, but we are not defining our strategy by size of the underlying assets, contrary to the buyout segment. We're size agnostic. We can invest in smaller, mid, or larger infrastructure assets, but our preference goes for yielding assets. So we're not investing in greenfield operations. We're a brownfield investor. We're looking for investments that provide a combination of capital gain at exit, but importantly as well, current annual cash yield in order to be able to produce a risk-reward ratio that is very different to the private equity buyout approach that I just described. We are mostly a co-investor. Yes, we do some primary commitments into funds, but we're mostly a co-investor and a very experienced co-investor. Our teams comes from direct investment backgrounds, and therefore we are able to co-lead. We are able to be involved extremely early in the makings of a deal and have a very strong experience with more than 60 investments in European infrastructure assets over the last 10 years. In buyouts, what is our main differentiation is the fact that we're a conviction-based investor. We're not waiting for others to show the way. We are actually leaders and innovators in our space, having the ability to partner with GPs, and a lot of the time with emerging GPs or GPs in their second or third generation, in order to actually design opportunities for our funds. We are very strong believers in concentrated portfolios. We're not trying to over diversify. We're looking for alignment of interest with GPs, and in that, we're crafting special situations most of the time when we invest with small cap buyout GPs. And that, I think, sets us apart and creates a sort of relationship with GPs, which is very different to a traditional LP. And that paves the way to secondary opportunities that we also design with GPs when we talk about GP-led situations, as well as co-investment opportunities, obviously being the largest investor with many of these GPs. So that's, I think, is a very strong differentiation. The other differentiation obviously comes from performance and ability to perform at levels which are similar to that of a very good direct fund in the same space. So showing that our selection and our investment DNA produces returns that are in tune with that expectation of being a market leader in the small cap space. When it comes to infrastructure, it's a very different differentiation that we have. The differentiation that we have is that we're not trying to compete with GPs. We're trying to provide solutions to them when they need to gather a syndicate for the acquisition of an asset. And we have strong sector expertise, having been an investor in many, many assets across many years in our current access form, but also the team had a previous track record before access. So, I mean, in areas such as energy or telecoms, we have extremely strong credentials, and we're able to add value to GPs when they are looking at an investment in that space. We can put large tickets also up to 100 million per deal, which helps GPs to have a significant partner alongside them to go after an opportunity. Talking about European smaller buyouts, I think investors have woken up to the fact that that space is interesting. And that has happened in the last 3 years. Because before that, I mean, most of the attention among LPs was focused on mid and large cap. And the last 3 years have shown that these segments have had one major issue: liquidity. Mid and large funds were not distributing. They were a bit stuck for multiple reasons. Obviously, reasons linked to the lower availability of debt, the increasing interest rates at some point in time in the cycle, and basically the fact that maybe they had also overpaid for some assets and that they needed more time to create value. So mid and large cap are very cyclical markets, and we've seen that across the history of the private equity industry. And investors have started to recognize that at the smaller end, there's less of that volatility. The issue at the smaller end is quality, and that's why you have to be hyper selective, and that's why people like us are helping LPs to navigate that space. But you have lower volatility because you have lower entry pricing, you have lower use of leverage, and you have more M&A at exit on a continuous basis than for the larger assets. And that's exactly what the last 3 years have demonstrated. And when we look at most of the industry, you had a peak of liquidity in 21 post-COVID. So everybody was selling, it was great, fantastic distributions, and then it dropped. We had interest rates, we had inflation, and that created, following the breakout of the Ukraine war, a situation whereby the market was stuck. And when we look at our own statistics, we've been distributing as much in 22, 23, 24 than we had in 21. So we had more inherent liquidity. Reasons are interesting to look at. First of all, we used to sell companies through GPs or directly 50% to larger corporates, 50% to larger funds. And that situation has evolved. because larger funds have increasingly captured a big share of the economy. And when you sell to a corporate, a lot of the time behind that corporate, there's actually a fund. So if you would look at direct and indirect exits, they tend now to be 70% to companies that are private equity backed or to funds. And larger quoted acquirers are now only about 30% of our exits. And that move towards more direct and indirect private equity exit is extremely beneficial to us because we're a provider of deals to that segment of the market, which has a lot of money. And, and definitely that has created a situation where we were almost opposite to the market in terms of M&A activity and exit. So I think that's a very important aspect of the small cap space. With the right selectivity level, you can produce very strong returns, and your LPs are enabled to do the same job that you're doing. LPs can very easily access mid cap, large cap funds. Small caps is another ball game. Again, more complex market, a lot of selectivity, know-how, relationships that you need to have in order to craft the right portfolio. On infrastructure, it's been the most stable asset class in Europe that you can think of. I mean, definitely when we look at the way that our infrastructure funds have been creating value quarter after quarter, I mean, there's almost no volatility. But you have to make certain choices in order to create that. Obviously, if you are trying to replicate the private equity model into infrastructure, you're going to create volatility because you're going to rely on value creation, you're going to rely on execution by management teams. So that sort of value add infrastructure, which has taken a large share of the infrastructure market, has positive aspects because you can potentially shoot for higher returns, but it also introduces volatility in the outcomes. So we've steered clear of that movement in the market to focus more on more stable cash generating assets using less leverage at acquisition. And that has created, obviously, much more stable returns. So definitely we're big fans of infra equity investments, but with the caveat that I've just mentioned. I would say that you have to look at Europe differently because if you're looking for GDP growth, that's not where you're going to find the largest GDP growth. I mean, definitely. But when you compare GDP growth in Europe versus buyout and infra returns in Europe, you start to realize that, I mean, for the last 25 years, we haven't had any growth on this continent. And still we're producing returns from those market segments. So you have to change the way you look at things. First of all, you're betting on sectors. You're betting on teams, and you're also taking advantage of the fragmented nature of the European market. Europe is a mosaic. It's a combination of countries with different dynamics, and the big role of private equity and infrastructure investment is to try and harmonize that. From the business standpoint, I mean, the politicians are not really good at harmonizing. Business is very good. And I was talking about consolidation of fragmented sectors. I mean, that consolidation is happening across borders. And you're not looking at a regional investment strategy. You're looking at a pan-European investment strategy. You start from a country, but then you start acquiring businesses across borders. And then you create a European leader. That story is a never-ending story because sectors change, because new opportunities arise. And GPs are very much focused on that. Buy and build and create that European platform is very much the name of the game here. And it's slightly more difficult to do than in the US, but the rewards are there when you do create that because there is inherent value. So definitely, Europe is lower volatility. It doesn't go as high, it doesn't go as low, but you have those pockets of opportunities within sectors, within geographies, and that ability to uh, piece up a European market leader in different industries. Well, I think the most important element to worry about is avoiding to overpay. And definitely, the dynamics of some of these markets mean that at some point in time, some sectors are hot, and that there's a lot of money flowing in those sectors, and then you end up overpaying for assets. And that is the biggest hurdle you'll face in order to create your returns. If you overpaid at entry, it's going to take a long time for you to recover from that. If on top of that, you're putting a lot of leverage to support your return, you're creating risk. And I think we're seeing that. And that's both the case for private equity and infrastructure. So paying attention to what your GPs are doing in that respect is paramount to creating the returns. It's very difficult to do that when you're investing in very large funds because you don't have much to say, and they're machines. When it comes to the smaller funds in which we are investors in buyouts, we are basically able to try and design some of the parameters with them. And definitely, if we look at the small cap markets in 25 or 24, we've been paying on average 8 times EBITDA for companies. And that has been very, very constant over the years. But that's a function of the size of the companies you're targeting. It's a function of how much GPs have uh, in terms of fund size. And that's a function of your own appetite for leverage. And definitely, we think that these are very important aspects that LPs should focus on. That's what we focus on in order not to have obstacles already from the beginning of the race. And overpaying is the biggest obstacle of them all. So definitely, we're concerned with some of the valuations at the higher end, but we're very happy when we're selling companies to them that they overpay, because definitely that creates an outside return for us. In buyouts, I mean, we've made our best returns in buy and build situations in the B2B software area, where we're seeing the ability to start with top quality management, top quality product, but with a small platform that is able then to go on and make multiple acquisitions across Europe and create a market leader. Uh, and when we enter in those situations, when companies are 4 or 5 million EBITDA, and we're able to pay single digit EBITDA multiples. When we exit, those sectors are very hot, and we are seeing quite often exit happening at between 15 to 20 times EBITDA. So if you're creating scale, if you're going from 5 million to 30 million EBITDA, and you get this rewriting element of multiple expansion, then you create outsized returns. And that has been a pattern of some of the GPs we've been working with, some of the deals we've co-invested in, and that is very much, I mean, the hottest types of deals that we have in our portfolios. Obviously, you have to be careful because, I mean, if you look at the software market, it's being fundamentally changed by artificial intelligence, and therefore a lot of your analysis has to go on what is changing in that space and how it is accelerated and how is the business model changed by artificial intelligence. But that opens new opportunities, and that's what we're seeing right now. So definitely a hot sector that will continue to be hot, but with now an accelerator effect that needs to be taken into context. In infrastructure, definitely we've seen waves of deals in different sectors. And I think one of the key waves that we're taking right now is in the recycling and waste management and waste to energy space. where we are invested in some European consolidations uh, of such companies, which we believe bring a lot of value to the society, and also are creating investment opportunities in terms of making them much bigger platforms than they have been until now. Again, pan-European platforms. So we think that this is a very interesting space. We are invested in that space. We're seeing growth. We're seeing consolidation in the space, and we're very excited by that. Well, I hope that the picture we've painted is an attractive one, and I think there's always the question of when and trying to time the market. And I think the beauty of private equity and infrastructure is that you shouldn't try to time the market too much. I think you should be consistent. And definitely, if you are drawing the matrix of asset allocation across the globe, I think there's definitely a space for Europe in that. First of all, in terms of size of the market, I mean, look in terms of how many consumers, how much investment is made there. The fact that we also, as private investors, need to supplement our governments. That's particularly true in infrastructure. That's particularly true in small business investment. So definitely, it's not a question of the time is now. Is the question that Europe is a fundamental part of an asset allocation that looks at the globe. It has different features compared to the US. It's not as dynamic as the US, but look at the returns. And you will see that there is consistency and there is an opportunity to continue with that pattern within the European market.